Stop watching the chart, not metaphorically, not emotionally. Literally, stop staring at the numbers flashing on your screen, because the numbers are no longer telling you the truth. The red and green candles you are refreshing every 30 seconds have already become obsolete. They are delayed signals from a system that no longer exists in functional form. You are looking at the echo of a market that died earlier today. Right now, the most dangerous mistake you can make is believing that price discovery is still happening. It is not. What determines whether you preserve wealth or lose it entirely has nothing to do with whether silver prints $94 or $96 by the close. That obsession is a distraction, a trap, a relic of a system that functioned yesterday but no longer functions today. What matters now is not price. It is not momentum. It is not technical analysis. It is the plumbing, the infrastructure, the invisible mechanisms that allow a buyer and seller to meet, exchange value, and walk away whole. As of Wednesday morning, January 21st, 2026, that infrastructure has fractured. This is not hyperbole. This is not a dramatic framing device. The wholesale silver market in the United States has entered a liquidity freeze, not a slowdown, not a tight market, a freeze. The pipes are empty. The gears are locked. The middle layer that allows metal to move from vault to investor has stopped functioning. And when liquidity dies, price becomes meaningless. For 5 years, warnings were issued. Inventory was thinning. Mining output was declining. Demand was steadily rising. Those were problems of scarcity, and scarcity still assumes a functioning market. A shortage implies that the system is alive but strained. What we are witnessing now is not a shortage, it is a system failure. Earlier today, internal wholesale trade sheets surfaced from one of the largest authorized purchasers connected to the United States Mint. These are not retail dealers. These are not online storefronts. These are the apex institutions of the bullion supply chain, the entities with billion-dollar credit lines, the firms that sit one step away from sovereign issuance itself. To understand the gravity of what this means, you need to understand the hierarchy. At the base are retail investors, individuals buying coins, bars, rounds. Above them sit local coin shops. Above those shops sit online dealers. But above all of them, sitting closest to the source of newly minted metal, are the authorized purchasers. These firms do not speculate. They do not chase price. They exist to provide liquidity. They are the heart that pumps metal into circulation. Every trading day, normally without fail, these firms distribute a trade sheet to their dealer networks. It is not marketing, it is not commentary, it is a menu, thousands of line items, every product, every bar size, every sovereign coin. Next to each item are two numbers, a bid and an ask. That sheet is proof of life. It is evidence that the market is breathing. Today, that sheet arrived blank, not partially filled, not delayed, blank. On the sell side, the column indicating what dealers can buy for customers, the status is uniform, red, repetitive, absolute, sold out. Sold out, not available, back order date unknown. American Silver Eagles, unavailable. Generic rounds, unavailable. 100-ounce bars, unavailable. Industrial bars, unavailable. Orders are not being delayed. They are not being queued. They are not being rationed. They are not being accepted at all. The wholesale shelves are not low. They are bare. If a local coin shop were to call today with a 7-figure cash buyer, a real buyer, not a browser, the answer would be simple and final. No inventory exists to sell. That alone would be alarming. But the true signal of collapse is not on the sell side. It is on the buy side. In a functioning market, scarcity triggers competition. Dealers raise bids, premiums expand, cash chases metal. That is how supply imbalances heal. High prices attract sellers. But today, something unprecedented is happening. The bid column is not rising. It is gone. No bid. Let that settle. The largest wholesalers in the United States are no longer buying silver at any price. Not at spot, not at premium, not at distressed discount. The buy button is turned off. If you arrived at the loading dock today with a truck carrying 10,000 ounces of pristine deliverable silver, the gates would not open. No offer would be made. No negotiation would occur. You would be turned away. This is not a pricing issue. It is a liquidity failure. A market requires two participants, a buyer and a seller. Right now, the United States wholesale silver market has neither. Sellers exist without buyers. Buyers exist without sellers. The bridge between them, the wholesaler, has collapsed. This is the moment when a market stops being a market. The implications ripple outward instantly. Local coin shops cannot restock. Online dealers cannot hedge. Websites widen spreads to absurd levels or go offline entirely. Liquidity evaporates. What looks like volatility is actually paralysis. And the question everyone is now asking is deceptively simple. How did this happen during the greatest silver bull market in modern history? Shouldn't these firms be flush with cash? Shouldn't rising prices be their windfall? The answer exposes the fatal flaw at the core of the Western financial system. This is not a supply crisis. This is a capital crisis. Wholesale dealers are not speculators. They do not bet on price direction. They operate as logistics firms. Their business model depends on thin margins and massive volume. To survive volatility, they hedge. Every ounce of physical silver they acquire is paired with a paper short position. The goal is neutrality. If price falls, losses on inventory are offset by gains on the hedge. If price rises, the reverse occurs. In theory, the system is stable. In reality, it contains a hidden kill switch. Hedging neutralizes price risk, but it magnifies liquidity risk. When silver was stable, this model worked. When silver trended gradually, it worked. But in a vertical price explosion, it becomes lethal, because paper losses demand cash immediately. A dealer who acquired metal at $25 and hedged accordingly is now facing a $70 loss per ounce on paper. The physical inventory may have appreciated, but it cannot be liquidated instantly without realizing the hedge loss. The futures exchange does not accept metal as payment. It demands cash. Margin calls arrive daily, sometimes hourly, and when price moves this violently, the required liquidity becomes astronomical. Credit lines designed for normal volatility are obliterated in days. Banks tighten, lending freezes, and suddenly firms sitting on hundreds of millions in assets cannot write a $5,000 check. They are solvent, but they are dead. This is the moment when price ceases to matter, because no price can clear a market without liquidity. The freeze has begun. To understand why this collapse was inevitable, you must understand the hedge, not as a technical instrument, but as a philosophical bet. Wholesale bullion dealers do not believe in silver. That statement will offend some people, but it is accurate. They do not believe in silver as money. They do not believe in silver as protection. They believe in silver as inventory, a product to be moved, insured, neutralized, and monetized through spread and turnover. Their allegiance is not to metal. It is to stability. And stability in the modern Western system is defined by the dollar. When a dealer hedges physical silver using paper contracts, they are making a silent assumption that the paper system will remain liquid, functional, and solvent no matter what happens to the underlying asset. They are betting that the dollar system itself will hold. That bet is now failing. Consider the mechanics without emotion. A dealer acquires 1 million ounces of silver at $25. They simultaneously short 1 million ounces in the futures market at the same price. On paper, the position is neutral. The bank extends credit comfortably. Everyone sleeps well. Then the environment changes. Not gradually, not cyclically, structurally. A cascade of events, geopolitical stress, energy shortages, sovereign buying programs, currency debasement, ignites a vertical repricing of silver. The price accelerates beyond historical volatility models. It gaps higher. It does not retrace. At $95, the dealer's physical inventory appears heroic, $70 million in unrealized gain. But the hedge bleeds. Every dollar higher is a dollar owed in cash, not someday, now. The exchange does not care that the dealer has the silver. It cares that the paper position is underwater. Margin is demanded in fiat currency, wired daily. At scale, this becomes impossible. The dealer borrows to meet margin. The bank lends, briefly, but credit is finite, and volatility is now exponential. Soon the bank stops answering. This is where theory breaks. The hedge was never designed for hyperinflationary repricing. It was designed for mean reversion. It assumed that violent upside moves were improbable. That assumption was wrong. The hedge did not protect the dealer from risk. It transferred risk into a form that requires constant liquidity. And liquidity is the one thing disappearing fastest. The cruel irony is this: if the dealer had done nothing, if they had held the metal unhedged, they would be extraordinarily wealthy today. But because they insured against downside, they insured themselves against survival. This is not incompetence. It is structural fragility. As silver prices rise, the capital required to operate the business multiplies. A $10 million credit line that once financed hundreds of thousands of ounces now finances a fraction of that volume. Purchasing power collapses. Inventory becomes unaffordable. The business suffocates. And while the dealers drown, the banks collect. Margin payments flow one direction. When defaults occur, collateral is seized, warehouses change hands, physical metal migrates upward into fewer, stronger vaults. This is not a market malfunction. It is a consolidation. The Western silver market was built on leverage, hedging, and trust in paper settlement. That architecture cannot survive a loss of confidence in the currency that underpins it. The hedge became a noose because it was anchored to a dying system, and as the rope tightens, something else becomes visible. The world outside the dollar system is still trading. The moment the hedge fails, the illusion of scale collapses. From the outside, wholesale bullion dealers look untouchable. Warehouses, armored trucks, billion-dollar balance sheets, government contracts, but all of that size is conditional. All of it is dependent on one fragile assumption, that credit will always be available tomorrow. That assumption has now been invalidated. What most people do not understand, and what almost no retail investor ever sees, is that the modern commodities market is not a market of metal. It is a market of credit. Metal moves only when credit moves first. The silver itself is inert. It does nothing. It just sits. The real engine is leverage. When leverage stops, metal stops. And leverage has stopped. The first sign is always silence. Phones stop ringing. Emails stop getting answered. The trading desk goes quiet. Not because nothing is happening, but because too much is happening too fast. Decisions are no longer being made by traders. They are being made by risk committees, by bank compliance departments, by credit officers whose job is not to make money but to prevent loss. This is where markets go to die. Inside every major wholesale dealer, the same scene is unfolding. Risk models that assumed volatility bands of 5% are being shattered by moves of 30, 40, 50%. Margin forecasts that assumed days to respond are now being triggered overnight. Liquidity buffers that were meant to last quarters are gone in hours. The dealer does not wake up bankrupt, they wake up frozen. Credit lines are technically still open but functionally inaccessible. Banks have not formally pulled the plug. They have done something more dangerous. They have slowed response times. They have introduced review processes. They have asked for updated collateral valuations. They have demanded additional documentation. In a fast market, delay is death. Every hour that passes without liquidity is another margin call due. Every margin call drains more cash. And because the dealer's cash is already pledged, every new obligation compounds stress nonlinearly. This is how liquidity spirals work. They do not unwind gently, they cascade. At this stage, the dealer faces three impossible choices. Option 1, sell physical metal to raise cash. But selling physical requires unwinding the hedge. Unwinding the hedge crystallizes losses. Losses require more cash. The act of selling triggers the very margin event they are trying to avoid. Option 2, roll the hedge forward. But rolling requires additional margin, and liquidity is already exhausted. The exchange demands more collateral, not less, because volatility has increased. Option 3, stop trading, freeze buying, freeze selling, preserve what little liquidity remains. This is the choice being made. Not because it is optimal, because it is the only survivable option left. This is why the no bid sign appears. It is not a judgment on silver. It is not a signal of low demand. It is a confession of insolvency risk. When a wholesaler posts no bid, what they are really saying is this: we cannot survive another dollar of price movement. That sentence alone should terrify anyone still thinking in terms of charts. Markets do not collapse when assets lose value. They collapse when intermediaries lose liquidity. Value can exist without markets. Markets cannot exist without liquidity. This distinction matters now more than at any point in modern financial history, because silver is not losing value. It is destroying the system that was built to distribute it, and once the intermediaries freeze, contagion begins. Local coin shops feel it immediately. They call their wholesalers to restock. They are told inventory is unavailable. They try a second supplier, same answer. A third, same answer. Within hours, shelves go empty. Spreads explode. Signs appear in windows. Limited quantities. Cash only. Call for pricing. Online dealers react next. Their business model is even more fragile. They rely on constant hedging to manage inventory risk. When hedging becomes impossible, spreads become undefined. Websites either display absurd prices or go offline entirely. This is not panic. This is rational risk avoidance. The public, however, reads it differently. From the outside, it looks like demand is exploding. And it is. But demand is not the problem. Supply is not the problem. The problem is that the mechanism that connects the two has failed. This is where the concept of price dies. Because price is not an inherent property of an asset. Price is an agreement between two solvent parties. Remove solvency, and price becomes a hallucination. This is why the number on your screen is now meaningless. The futures market continues to print trades, contracts exchange hands, algorithms still fire. But these are paper transactions occurring in an environment that assumes settlement will always be possible. That assumption is now under stress. The moment physical delivery becomes preferable to rolling, the futures market ceases to function as a price discovery mechanism and becomes a run. And runs do not respect logic, they respect urgency. At this stage, banks stop behaving like liquidity providers and start behaving like asset consolidators. Their objective shifts from facilitating trade to securing collateral. They are no longer neutral intermediaries. They are predators in a stressed ecosystem. This is why margin calls accelerate instead of easing. From the bank's perspective, this is not cruelty. It is math. When volatility rises, risk rises. When risk rises, capital requirements rise. When capital requirements rise and liquidity falls, the rational response is to demand more collateral now, not later. Later may not exist. This is the point where the wholesale dealer realizes a brutal truth. Their survival depends not on silver going up or down, but on silver stopping. They need time. Time for volatility to compress, time for margin requirements to stabilize, time for banks to regain confidence. But time is exactly what a vertical market does not provide. Every new high is another wound. Every dollar higher is another wire transfer demanded. The dealer is now trapped between two unstoppable forces, rising asset prices and shrinking credit. This is the precise definition of a liquidity death spiral. And death spirals do not resolve themselves. They end in failure, consolidation, or intervention. Intervention is not coming, not because authorities are unaware, but because this failure does not threaten the currency directly, yet. It threatens an industry, and industries are allowed to fail, especially when their failure benefits larger institutions, because while dealers freeze, someone else is still buying, and that someone has no need for credit. They are buying with cash. They are buying without hedges. They are buying for possession, not for resale. This is where the story leaves the Western financial architecture entirely, because outside the dollar system, none of these constraints apply. Outside the dollar system, silver is not a hedged inventory item. It is money, and money does not need margin. As the Western market locks itself into paralysis, the global market does something very different. It moves, not slowly, not cautiously, decisively. Metal flows toward the highest bidder who can settle immediately, and that bidder is no longer New York. It is not London. It is East. Toward markets that never believed in paper neutrality in the first place. Markets that never trusted leverage. Markets that do not require credit to function. This is where the real price begins to emerge, not as a number on a screen, but as a physical transaction, completed, paid, and removed from the system forever. And once that process starts, it does not reverse. Because metal that leaves the Western circulation network does not come back. It disappears into vaults, jewelry, industry, and cultural hoards. It exits the reflexive loop of hedging and leverage. It becomes inert again, but this time inert outside the reach of the paper system. This is why the freeze is not temporary. Liquidity crises resolve in only one of two ways, recapitalization or abandonment. The Western silver market is not being recapitalized, it is being abandoned. And as it is abandoned, the center of gravity shifts. Not gradually, violently. In the next chapter, the consequences of that shift become undeniable, because while America freezes, another market overheats. And that market does not care about COMEX, it cares about delivery. While the Western silver market freezes in place, paralyzed by margin calls and credit exhaustion, something fundamentally different is happening elsewhere in the world. There is no panic, there is no confusion, there is no debate about whether price is too high, there is only execution. Outside the dollar system, silver is not treated as a tradable exposure that must be neutralized. It is not something to be balanced against futures contracts or insured against volatility. It is treated as what it has always been treated as for most of human history, a final asset. In these markets, there is no concept of paper silver. There is no psychological comfort derived from being market neutral. There is no obsession with hedging away risk because the risk they fear is not price movement. The risk they fear is absence. This is the first and most important mental divide between East and West. The West fears volatility. The East fears unavailability. And when a market transitions from abundance to scarcity, that distinction determines who survives. As the Western wholesale network locks itself into defensive paralysis, the physical metal begins to reroute. Not because of conspiracy, not because of manipulation, but because capital is rational. Metal flows towards certainty. It flows toward counterparties who can settle immediately, without leverage, without delay, without excuses. That counterparty is no longer New York. The moment Western dealers shut down bids, they signal something catastrophic to the global market. They cannot absorb supply. The moment they stop selling, they signal something even worse. they cannot distribute supply. That combination is fatal, because in the physical world, metal does not wait. Refiners, fabricators, miners, sovereign buyers, industrial users, they all have one overriding constraint: continuity. They need metal to move. They need certainty of settlement. They cannot afford to participate in a system where inventory exists only on spreadsheets. When Western intermediaries fail to provide that certainty, global trade does not pause. It diverts. What determines whether you preserve wealth or lose it entirely has nothing to do with whether silver prints $94 or $96 by the close. That obsession is a distraction, a trap, a relic of a system that functioned yesterday but no longer functions today. What matters now is not price. It is not momentum. It is not technical analysis. It is the plumbing, the infrastructure, the invisible mechanisms that allow a buyer and seller to meet, exchange value, and walk away whole. As of Wednesday morning, January 21st, 2026, that infrastructure has fractured. This is not hyperbole. This is not a dramatic framing device. The wholesale silver market in the United States has entered a liquidity freeze, not a slowdown, not a tight market, a freeze. The pipes are empty. The gears are locked. The middle layer that allows metal to move from vault to investor has stopped functioning. And when liquidity dies, price becomes meaningless. I've learned that people forget what you said, forget what you did, but they'll never forget how you made them feel. The redirection is immediate and brutal. Bars that would normally be allocated to London vaults are reassigned. Cargo routes change. Shipping manifests are rewritten. Insurance policies are updated. Metal is placed on planes, not because price is higher elsewhere, but because execution risk is lower. This is a subtle but critical point that most observers miss. The East is not winning because it pays more. It is winning because it pays now. In Western markets, price discovery is entangled with credit. A high bid means nothing if it cannot be honored. In Eastern markets, price is meaningless without settlement. A deal that cannot be closed immediately is not a deal. This is why the physical premium explodes. Not because demand is irrational, but because certainty is scarce. The premium is not a bonus for silver. It is a discount on trust. In markets where trust in future delivery collapses, only present possession has value. That is why silver begins trading at materially different prices depending on geography. This divergence is not an anomaly. It is a signal. It tells you exactly where the real market is. In India, silver has never been financialized in the Western sense. It has never been abstracted into synthetic exposures or leveraged derivatives for mass participation. It is woven into daily life. It is cultural. It is physical. It is final. There is no tolerance for counterparty risk. If you do not have the metal, you do not own it. This worldview creates a market structure that behaves very differently under stress. When price rises sharply, Western participants ask, "Is this sustainable?" Eastern participants ask, "How much is left?" Those are not the same question. And in the current environment, only one of them matters. As whispers begin circulating that Western wholesalers are unable to restock, buyers in the East do not wait for confirmation. They do not wait for official statements. They do not wait for analysts to explain the move. They act because they understand something instinctively that Western investors have been trained to forget. Markets do not break gradually. They break suddenly, and they break permanently. Once a physical market dislocates from its paper reference, it does not snap back. It migrates. This is how commodity power shifts. Not through announcements, not through treaties, through silent redirection of supply chains. The moment refiners realize they can ship metal east and receive immediate payment at a premium, without hedging, without margin, without counterparty exposure, the decision becomes automatic. They do not need to speculate on future price. They simply need to avoid future risk. This is the irony that defines the current moment. Western markets are frozen because they are too sophisticated. Eastern markets are thriving because they are simple. No leverage, no hedges, no promises, just metal for cash. As this divergence accelerates, the Western pricing mechanism begins to fail in a very specific way. The futures market continues to function syntactically. Trades clear, contracts roll, prices print. But semantically, it loses meaning. The number exists. The market does not. This is what creates the zombie price. A price that reflects transactions in a closed loop of paper participants, disconnected from the physical flows that determine real availability. Zombie prices can persist for a while, but they are unstable. Because arbitrage does not care about narratives. It cares about spreads. And when the physical price in one region exceeds the paper price in another by a margin large enough to cover transport, insurance, and friction, arbitrage becomes irresistible. This is where the collapse accelerates. Metal is pulled out of the Western system not by ideology, but by profit. Not by fear, but by math. Every bar that leaves the Western vault reduces available inventory. Every reduction in inventory increases stress on paper settlement. Every increase in stress makes delivery more attractive. Every delivery drains the system further. This is a positive feedback loop. And positive feedback loops do not stabilize. They run until something breaks. In this case, what breaks is trust. Trust that contracts will be honored. Trust that metal will be there tomorrow. Trust that rolling is safer than taking. Once that trust erodes, the paper market becomes a liability rather than a convenience. Participants stop asking, "What is the price?" and start asking, "Can I get the metal?" That is the inflection point. Because once that question dominates, futures markets lose their purpose. They exist to defer settlement. A market that no longer wants deferral cannot be sustained by paper. This is why the East does not hedge. Hedging assumes continuity. Hedging assumes time. Hedging assumes a system that will still exist when the hedge needs to be unwound. The East does not assume that. It assumes disruption. It assumes confiscation. It assumes scarcity. And therefore, it does not insure against volatility. It insures against absence. By taking delivery, as more metal exits the Western system, something else begins to change. Something subtle, but profoundly important. The behavior of banks shifts. Because banks are not blind. They see the same flows. They see the same inventory data. They see the same delivery requests stacking up. They understand that metal leaving the system does not come back. And unlike dealers, banks are not neutral. They do not exist to facilitate trade. They exist to survive. This is where the next phase begins. Because when banks stop rolling and start taking, the game changes permanently. And that is exactly what is happening. In the next chapter, the focus moves to the one place that cannot hide this shift, the futures exchange itself, where delivery data reveals who understands what is coming and who does not. The futures market is built on one fragile habit: rolling. Contracts expire, but positions do not. Exposure is shifted forward. Risk is deferred. Settlement is postponed. This quiet choreography is what allows a paper market to function at a scale that dwarfs the underlying physical asset. It is not deception by default. It is convenience, a shared understanding that most participants do not want metal. They want duration. They want optionality. They want time. Rolling is trust, and trust is evaporating. For weeks, the signals were subtle. A slight increase in open interest near delivery months. A mild uptick in notices. Analysts dismissed it as noise. Seasonality. Statistical outliers. But those explanations relied on a premise that no longer holds, that the system itself is stable. Stability is gone. When price volatility explodes, rolling becomes expensive. Margin requirements increase. Spreads widen. Liquidity thins. Participants who once rolled reflexively begin to hesitate. They ask a different question. Not, what month do I want exposure in? But do I still trust this contract to settle later? That question is deadly to a futures market, because futures only work when the majority agree to postpone reality. The first entities to stop rolling are never retail traders. They are institutions with access to inventory data, entities that see warehouse flows, entities that understand logistics, not charts. Banks. Banks do not chase price. They chase certainty. When they roll, it is because rolling is safer than taking. When they stop rolling, it is because the risk has inverted. This inversion has now occurred. Delivery requests are rising not because participants suddenly want silver jewelry or solar panels. They are rising because participants no longer trust the future. This is the anatomy of a run. A bank run is not about insolvency at first. It is about timing. Everyone believes the bank is solvent, as long as they are not the last to withdraw. The moment doubt appears, the incentive shifts. Rational actors rush not because they expect failure, but because they fear delay. The same psychology governs futures delivery. When one participant takes delivery, it raises the probability that inventory will be lower for the next. When inventory declines, delivery risk rises. When delivery risk rises, more participants demand delivery. This is not panic. It is game theory. The moment banks begin taking delivery in size, the paper market loses its buffer. Because banks are not marginal players. They are structural. They sit at the intersection of credit, clearing, and custody. When they move, they change the system's posture. And they are moving now. Delivery notices that should not exist in quiet months are appearing. Contracts that historically roll without incident are being stood for settlement. The exchange, which relies on predictability, begins to show strain. Not because inventory is technically exhausted, not yet, but because velocity has changed. Metal is leaving faster than it is entering. This matters more than absolute levels. Futures exchanges are designed to manage static shortages. They are not designed to manage accelerating withdrawals. As banks demand delivery, warehouse stocks decline. Eligible becomes registered. Registered becomes allocated. Allocated becomes outbound. Every step reduces flexibility. Every outbound truck removes optionality. This is where the futures price decouples from physical reality. The price continues to trade, but the ability to deliver against it deteriorates. This is the hidden danger of paper markets. They can appear liquid until the very moment they are not. When delivery demand crosses a critical threshold, the exchange faces a dilemma: raise margins aggressively and risk forcing defaults, or allow delivery stress and risk reputational collapse. Neither option is survivable. Raising margins accelerates dealer failure. Defaults cascade. Confidence erodes further. Allowing delivery stress exposes the underlying scarcity. Confidence collapses instantly. This is why exchanges prefer time. Time allows narratives to form. Time allows interventions. Time allows participants to calm. But time is exactly what vertical markets remove. As the East continues to absorb physical metal without interruption, Western inventories are no longer replenished. Refiners redirect. Producers prioritize certainty. Arbitrage drains the system. The exchange becomes a bottleneck. And bottlenecks are not neutral. They amplify pressure. Participants who once trusted that rolling was safer than delivery now face a reversed calculus. Rolling means trusting the system for another month. Delivery means certainty today. In an environment where trust is collapsing, certainty commands a premium that price cannot capture. This is why delivery volumes surge in unexpected months. This is why banks, who normally avoid taking physical unless necessary, suddenly step forward. They are not speculating. They are securing position. Because banks understand something fundamental about crises that retail participants rarely grasp. Liquidity disappears before price reflects it. By the time price signals stress, it is too late to act. Banks act before price. They watch flows. They watch inventories. They watch behavior. And what they are seeing now is unmistakable. The Western silver market is not illiquid because demand is too high. It is illiquid because credit is gone. And credit, once withdrawn, does not return on sentiment. It returns only after consolidation. This is the part of the cycle most people misunderstand. They assume that once volatility subsides, liquidity will normalize. That banks will reopen lines. That dealers will restock. That spreads will compress. That assumption is false. Liquidity crises end with fewer participants, not more. Weak hands exit. Strong hands consolidate. Middlemen disappear. This is not a temporary dislocation. It is a structural purge. Banks taking delivery is not a rescue. It is an extraction. Every ounce they take is an ounce removed from circulation. It does not go back to wholesalers. It does not go back to retail channels. It disappears into balance sheets where it will not be traded. This is why delivery data matters more than price. Price can lie. Delivery cannot. As the run accelerates, the exchange's role changes. It stops being a facilitator of trade and becomes a referee of scarcity. Rules are enforced rigidly. Exceptions vanish. Force majeure language is quietly reviewed. Participants sense this shift instinctively. They stop asking about returns. They ask about access. The futures market, once a tool for managing risk, becomes a battlefield for securing assets. This is where paper silver reveals its fatal flaw. It promises optionality in a world that is removing options. It promises liquidity in a system that is withdrawing liquidity. It promises flexibility when rigidity is becoming the rule. This mismatch cannot persist. Either the physical market must flood the exchange, which it will not, or the paper market must concede. Concession does not mean collapse in one dramatic moment. It means irrelevance. A futures price that no longer governs physical flows is not a price. It is a reference, a suggestion, a relic. This is the stage we are entering now, the stage where price remains visible, but power has moved elsewhere, where screens still flicker, but decisions are made off-screen, where delivery volumes tell the truth that charts obscure. And the truth is this: the moment rolling stops, the futures market stops being a market of convenience and becomes a market of necessity. Necessity strips away illusions. Necessity reveals who understands the system and who is merely using it. In the next chapter, the consequences of this shift become unavoidable because once banks finish taking what they need, there is nothing left to buffer the system. No inventory, no trust, no time. And when that moment arrives, the price you see will no longer be debated. It will be dictated. There is a moment in every systemic collapse when denial ends. Not gradually, not politely, but abruptly, when the last illusion fails and reality asserts itself without negotiation. That moment has arrived. The silver market did not crash. It did not implode. It did not explode upward in a spectacular final candle. It simply stopped functioning. And that distinction matters more than any price you will ever see. Markets do not exist because assets exist. Assets can exist without markets for centuries. Markets exist only when trust exists. Trust that a buyer can pay. Trust that a seller can deliver. Trust that the middle layer can connect the two tomorrow the same way it did yesterday. That trust is gone. What you are witnessing is not volatility. It is not a bull market. It is not even a crisis in the traditional sense. It is a termination event. The Western silver market has reached the end of its usable life, not because silver failed, but because the system built around silver failed to survive success. This is the paradox that history always delivers and that modern finance always forgets. Assets do not destroy systems. Systems destroy themselves when assets expose their weaknesses. Silver did exactly that. For decades, the West treated silver as a derivative of confidence. It was financialized, fractionalized, leveraged, hedged, and abstracted until the physical metal became an inconvenience rather than the point. The paper system grew so large, so self-referential, that it no longer needed the metal to function until one day it did. And when that day came, the metal was gone. Not hidden, not hoarded maliciously. Gone because it was sold, delivered, exported, fabricated, and absorbed by entities that never believed in paper promises to begin with. The East did not win this market. The East simply played a different game. A game without leverage, without rolling, without synthetic substitutes, without faith in future settlement. While the West engineered complexity to extract yield, the East preserved simplicity to preserve wealth. And simplicity always outlives complexity under stress. The final failure point was not price divergence. It was liquidity extinction. The moment wholesalers could no longer bid, price ceased to exist as a clearing mechanism. The moment dealers could no longer restock, inventory ceased to exist as a buffer. The moment banks stopped rolling and started taking, time ceased to exist as a safety valve. From that point forward, collapse was guaranteed. Not dramatic collapse. Silent collapse. The kind that leaves screens functioning but meaning gone. The kind that keeps exchanges open but markets closed. The kind that convinces the uninformed that nothing has happened, while everything has already changed. This is why the most dangerous people in this moment are not the panicked. They are the complacent. They are the ones still arguing over whether silver is overbought, still debating whether a pullback is coming, still analyzing indicators built for a market structure that no longer exists. Those tools are obsolete. You cannot model a dead system. The futures price you see now is not a lie because it is manipulated. It is a lie because it is irrelevant. It is the output of a closed loop where paper trades paper, hedges hedge hedges, and settlement is assumed but no longer required. It is a museum exhibit. The real market has moved on. The real market is physical, immediate, and final. It is defined not by what someone is willing to pay eventually, but by what someone can pay now, in full, for metal that can be taken away today. That is the only price that matters. Everything else is commentary. This is why the Western system cannot recover. Recovery requires recapitalization. Recapitalization requires confidence. Confidence requires time. Time is gone. Even if credit lines reopen, they reopen smaller. Even if dealers return, they return weaker. Even if inventory rebuilds, it rebuilds elsewhere. The metal that left will not come back. It has changed status. It is no longer inventory. It is wealth. And wealth does not circulate the way inventory does. This is the final truth that no analyst wants to say out loud. The Western silver market did not experience a temporary freeze. It experienced a permanent migration. Pricing power has moved. Liquidity has moved. Trust has moved. New York and London did not lose control because someone took it from them. They lost it because they traded certainty for efficiency and forgot that efficiency collapses under stress. The system optimized for normal conditions. This is not a normal condition. This is a regime change. And regime changes do not reverse. They reset. That reset is now complete. If you are holding paper silver, ETFs, pool accounts, unallocated claims, understand exactly what you own. A promise issued by an intermediary whose business model depends on a market that no longer functions. That does not mean those claims will vanish tomorrow. It means they will fail when you need them most. Liquidity always disappears at the point of necessity. If you are holding physical silver, understand what you hold. An asset that no longer needs the Western market to exist, to trade, or to be valued. You are not holding an investment. You are holding an exit from the system that just failed. This is why desperate dealers will attempt to convince holders to sell. Not because silver is peaking, but because they are. They need your metal to survive one more day inside a structure that is already condemned. Do not confuse their urgency with insight. The market did not die because silver went too high. It died because silver exposed the cost of trusting a dying currency. This was always the end game. A paper system cannot price real money forever. Eventually, reality asserts itself, not with a crash, but with abandonment. The Western silver market has been abandoned. What replaces it will not look familiar. It will be smaller, more localized, more physical, more honest, less liquid, less convenient, less forgiving. That is the price of truth. The manipulation is not ending because regulators intervened. It is ending because the manipulators ran out of metal and ran out of credit. The system did not correct itself. It exhausted itself. This is not the end of silver. This is the end of pretending silver needed the paper system at all. The market is dead. Long live the price. End.